Good day, and welcome to yet another one of Randstad's weekly wraps. I'm Vivekananda. This week we'll cover the latest inflation numbers from South Africa, US job revisions, and then look at some developments in regulation in the tech sector. So, South African inflation came in at about 4.6%. That's pretty much on target. 4.5% is pretty much the target the Reserve Bank has set. Technically, our target range is 3 to 6%. 4.5 directly in the middle, 4.6 basically there. Given the unemployment rate in South Africa, given the low growth rate in South Africa, this pretty much means, if everything else was equal, that the Reserve Bank should be cutting interest rates in the next meeting. And I think that's probably what's going to be happening. It's going to happen just after the US Fed meeting. The US is almost certainly going to cut rates, so we'll follow thereafter. And we probably will take a lead from what the US is doing as well. If they cut, by a large amount, we'll probably cut by a large amount as well. Right now, the estimates are for a cut of about 0.25%, but there is like a third chance it'll be as much as 0.5%. That's for the US rate cut. And like I said, we'll probably follow their lead as well. I don't think that there's a argument or strong argument against basically cutting 0.5% even if they cut a quarter. We obviously have a higher interest rate than they do. We're pretty much on target and they are still heading towards their target. And our growth rates are obviously, worse than theirs are. So you could argue that there's more of a case for us to cut by a significant amount than it's for them. But like I said, we'll probably follow whatever they do. And we'll probably do, like I said, a cut in the next meeting by the Reserve Bank. Next, let's look at a revision in jobs numbers from the US. The US came out, so the US Department of Labor came out and said that basically they overcounted the number of jobs of the last year by about 818,000. That is a significant number of jobs. It's roughly 0.5% of the total US labor force. It would mean that there was about just under 70,000 jobs extra per month on average added over the last year. That means every time we saw these job numbers basically beat estimates, it was pretty much, an incorrect estimate or incorrect, reading. In fact, if these numbers are correct and, we have another revision down the line, it would likely have meant that the US did not add as many jobs as its population increase of that time, its workforce increase of the time. So technically, it wasn't keeping up with the growth in its labor force, which is, a bit of a negative. The last time this happened was back in 2009, 15 years ago. That, of course, should give you think about the global financial crisis. And yes, that is, pretty much the reason behind that as well. So many people are fearing that this might be an indicator of a recession. However, when you look at the last set of numbers that came through for the last time this was done, the GFC, what you would have found is that there was several indicators in advance that were showing that the US was in a recession. You were seeing firstly growth dropping. You were seeing the market under huge pressure. Many reports that were saying recession. And so when we had the revision come through, we kind of reinforced that. Right now, there's very little of that in the US. Right, there's no indicators from the stock market, from earnings releases, from growth reports that the US is in any kind of danger of going into a recession in the near term. So it could very well be that this number is just anomalous. And, in fact, another revision down the line might just change this. Also, most of the time when we do have a significant revision down, the next number will be a revision positive. So it's unlikely that we're going to have another negative, revision next year. So I would say that it's a concerning number. It's not what we want to be seeing, depending on how you think about interest rates and how you think about the market. But it is not an indicator that the US is in a serious danger of a recession just now. Definitely, even though there's a coincidence it happened, the last time this happened was 2009. This is a very different situation from 2009, and I don't think we can draw any conclusions from that. But speaking of what this does mean for the US economy, what this does mean for the Fed, etc., going forward, I think it pretty much guarantees that there is going to be a rate cut coming through in September for the US Fed. I think that, the fact that we saw, estimates for a 1/3 chance of a 0.5% rate cut, that's more justified, I would think, than it were before these numbers came out. Look, the market had anticipated this. It was broadcast out there, but and then maybe that's one of the reasons we saw this estimate for 0.5% coming through for the next rate cut for the US. But I do think that still the Fed is more likely than not to do a 0.25% cut. The reason being is that 0.5%, even though it might be justified by if you say that the economy is much weaker than we thought, inflation's under control, blah blah blah. I think the danger of 0.5% is that it might spook the market into thinking, what is so crazy about the economy right now that they have to cut by 0.5%? Because the Fed doesn't usually move by 0.5% unless there's some really strong indicators that say they have to do 0.5%. So if they moved 0.5%, when the market is saying, oh, we don't see anything real, recession right on the cards right now. We don't see, difficulty in the economy at the moment. Why are you doing 0.5%? Are you seeing a difficulty that we don't see just now? And that might have a negative effect on things, more than anything else. So yeah, even though we see the estimates for a 1/3 chance of 0.5%, I think that the Fed would probably be nervous about going that far. But one last caveat to put in advance here. We are less than 60 days away from the next US election. So it's about 60 days away for the next US election. So we're talking about the 5th of November. So we're talking the remainder of August, September, October, then November. So just over 60 days. Now, in that time period, the Fed is going to be under huge pressure to do something to basically boost the chance of the incumbent. I don't want to say the Fed is biased. I don't want to say the Fed, is taking sides here. But honestly, the incentives are all in favor of boosting Kamala Harris's chances. And what would you do in order to get that done? You want to cut interest rates. And right now, Kamala Harris has had a few good weeks. She went with Biden, in the ticket. He was losing dramatically across, the U.S. In fact, losing so badly, he was probably going to hurt the Senate and Congress chances for the U.S. Democratic Party. But Harris has basically recovered most of those losses. And in fact, right now, she's leading Trump in the overall election. The overall election, however, doesn't really matter. It's about the electoral votes. And so in the US, quite frankly, it comes down to about 20% of their total electorate that really matters in the election. If you live in California, if you live in New York, you live in some of the southern states, your vote does not count because your states are going to go either Democrat or Republican, irrespective of whoever is in charge or whoever running. Right now, there's about 7-8 states that really matter. And whoever wins the right combination of those 7-8 states is going to win the US election. Harris is pretty much tied in those states. In fact, by some estimates, she's still slightly behind. So even though she's ahead on the popular vote, she's either tied or slightly behind on the electoral college vote, which would be, just the same as losing overall. Doesn't matter if you win 10% more popular vote, that means the total number of votes, you get 10% more. If you don't win the electoral college, you still lose. In fact, that's how we saw, for instance, a number of Republicans have won. George Bush beat, I think it was Kerry, and I think would Gore as well. With the less votes. Trump won against Hillary with less votes, but he won the electoral college. So Harris could be in a bad situation going into September, especially if she doesn't get a boost like she wants to get a boost out of the Democratic National Convention, which happened this week. So in that scenario, bring it back to the stock market. It is possible that the Fed could act in a way that is surprising. So even though I still think that there's a majority chance that they are going to do a quarter cut, don't ignore the possibility it could be bigger. And a third, towards half a percent might be possible, maybe even more. I mean, there are people out there discussing the necessity of maybe doing a 1% or more. They are not in the, they say they're a very tiny minority. But like I said, we're talking about a person making the decision, Jerome Powell, along with the rest of the Fed. We are talking about a very, very tight political race in the US at the moment, and we're talking about a lot of pressure coming through. So don't be too surprised about anything out there. Okay, that's one. Now let's move on to what's happening in US tech regulation at the moment. There's an important case, I've spoken in the past, which is that Google has faced allegations of acting like a monopoly, and therefore is facing sanction. And the rule to be actually act like monopoly, and is facing some kind of sanction based on this ruling. And there's two basic ways this is going to turn out. Either you split the company into various parts, or you give them or you make them sign some kind of agreement that they'll behave in a certain way for a certain amount of time to reduce these monopoly effects. Now, both of these things are negative, but I actually think as a shareholder, if you are Google's shareholders, you rather prefer to be split than to actually have your company operate under one of these decrees. The reason for this is quite simple. The last time we saw a company with this kind of dominant power operate under this kind of decree, it was Microsoft. And effectively, that was the entire of the Steve Ballmer era. And during Steve Ballmer's era at Microsoft, which is over a decade, we did see Microsoft's share price, I think, fall about 8% of that period. Satya Nadella has come and taken over, and maybe he's a better manager, maybe he's dealing with better things, a better situation. But one of the things that he's really dealing with is not that having that decree over his head. And in that time, Microsoft's share price has gone up many multiples. And no, it's not exactly the same. It's not the same amount of time that Steve Ballmer was in charge, that Satya Nadella has been in charge. And he's basically done significantly better in terms of performance. If we do see Microsoft, of course, Google being issued one of these decrees, having to sign some kind of agreement with the US government about how they operate going into the future, it's pretty much, I think, going to destroy that company as an investment opportunity for several years. Because it would mean that they can't operate in any of the new technologies that are going to be coming out over the next few years. I mean, people that are younger don't remember this, but Microsoft used to be like Apple plus Google plus Facebook. The entire tech sector combined used to be Microsoft. That's how powerful they were in the tech sphere. And if you had told me back, before the agreement with the US government had been signed, that over the next several years, we're going to get social media, we're going to get the search, feature, the search engine being created, you're going to get mobile phones being created, and you're going to say that Microsoft was going to be involved in none of these things, I would have thought, no, that's crazy. At least part of some of them, you know what I mean? But in all the major trends until cloud computing and until AI, which is very recent, Microsoft was there's no Microsoft. I mean, Bing is, also ran in the search sphere. They're not having any kind of real, traction. Mobile. I mean, they did try the Microsoft phone, but never worked out. Microsoft tried that iPod competitor, Zoom, never worked out. Social media, nothing really happened there. Yes, they have Teams now that's done really well, but they have no version of Facebook or Instagram or Twitter or anything like that. And they could have easily created this. They were that dominant in the sphere. All because I believe that they were hamstrung by this government decree. Because what this decree would mean would be every time you want to make a new decision about a new product that you want to launch or get involved in new kind of innovation, you'd have to get government approved for it. And you can't really be as aggressive and as innovative as you want to be, because the government's probably going to say no to all this stuff. So effectively, all you can do is hunker down and just do your core business. Okay, that's the one thing. Now let's go to the other aspect. What would happen if they want to split Google up? What would be the different divisions? Well, you could argue that there's certain different parts of the company that are viable. I mean, the search business is viable on its own. YouTube is more than a competitor for Netflix on its own. If you had YouTube on its own, it's probably the most powerful streaming service in the world. The most valuable streaming service in the world, sorry. Talking about the ad business, that's the thing being its own. Android could possibly be its own business. Waymo, this is their self-driving vehicles, could be its own business. So we're talking about multiple different businesses that, are currently in Google. Historically, when you have multiple businesses operating under a single label or a single entity, the valuation the market gives for these businesses is usually less than the value they'd be getting if they're operating separately. There is a kind of a tax for being part of a conglomerate. So if you do have Google split up it's quite possible as Google shareholders, you could be holding more Google share value than if you were dealing with a single company, and probably almost certainly more value than you were dealing with a single company that's operating under a government decree about what it can and cannot do. So Google being split up is, I think, not a majority prospect, but it is, I think, a definite chance of it happening. And if you're a Google shareholder, Alphabet shareholder, I think that's probably the best case scenario for you. Now, just one thing I want to add on beyond this is, why is this happening? Well, normally what you had in the US was a bit of a balance, an equilibrium. Republicans were pro, corporates, and you had the Democrats were pro, kind of labor, pro, more socialist kind of policies. So Democrats basically tried to do bad things to business, tax them, more regulations and so on. And Republicans were kind of the defenders of business. They would step in and help businesses out if things are looking very bad. Okay, they would prevent regulation that would harm their profitability. They would try and decrease the power of labor, that kind of stuff. But the U.S. government, or the U.S. political system, has gone through a realignment over the last several years. And one of the things that's happened is that a lot of big business, especially big tech, has turned away from the Republicans and been much more democratic, supporting. In fact, look at the last election, and I think the vast majority of workers at Google and any of the tech companies were supporting the Democrats over the Republicans. In fact, I think the only big institutions in the U.S. that actually supported the Republicans over the Democrats were the police union and the military. Every single other big industry or business or whatever it was out there supported the Democrats. So the Republicans don't have as much incentive to support or protect a Google, or possibly down the line a Facebook. I mean, Facebook could be an Instagram and Facebook and WhatsApp. That's not a difficult way to imagine this thing. Or an Apple. The Apple could be multiple businesses. The App Store could be separate. That's a possibility. Even looking at something like, for instance, Amazon, separate the cloud and the retail business. Stop the retail business from selling its own products, like Amazon branded stuff on its retail platform. These are all things that could be happening over the next several years. And the thing is that I think that there's no real protection against it politically for these companies. So we're looking at a very dangerous time for any kind of company out there that has any kind of monopoly power. And I think that is something that we have to keep in mind as we look forward over the next few years. Okay, that's it for me this week. Thanks for having me, and I'll look forward to speaking to you guys again next week. Cheers.